Well, hi everyone, and welcome to the webinar that we've got today, which is the Investors Roadmap for 2024. I'm Tom Wilson. I'm the investor educator at InvestSMART. I'm joined by our head of portfolio services, Mitchell Sneddon. Hi, Mitchell. Welcome.
Hey, Tom.
Today we've got a lot of topics to cover, and how these webinars are working is they're very interactive. You can actually ask questions as we go, and they'll appear in the chat. And we'll even add some to the screen where we think everyone will benefit from seeing it. First of all, as always, just a disclaimer, we provide general product advice only, not any type of personal financial advice. But that being said, let's start looking at the major themes of 2023.
Yeah, let's jump into it, guys. These all should be pretty familiar to you. 2023 saw financial news essentially take the main headlines of the mainstream news for the entire course of the year, which is generally speaking quite unusual. We don't often see that unless it's generally a GFC-like kind of scenario. So interest rates were the main theme of 2023 for me. We started the year, if you look back at it, in January with the interest cash rate set at 3.1%. We actually had 5 interest rate increases throughout the year, and we finished up at 4.35%. Interest rates were, as I said, dominated headlines. I remember the term the mortgage cliff.
Yep.
Really scaring a lot of people, are putting a lot of fear into the market and a lot of uncertainty. I do sit back now, and when I was putting this together, I thought, oh yeah, I'd actually forgotten the term mortgage cliff. Now, I don't mean to downplay it, because I'm absolutely certain there's a lot of people out there who felt a lot of pain around that, but I know that uncertainty didn't really flow through into the market, because as we move forward, I'll go through the asset class returns of 2023. You see they were actually quite strong across the board. Now, of course, the cost of living pressures and the property prices were a flow-on effect from the interest rate headlines. And they also flowed on to creating that more an uncertain environment for investors. We then had geopolitical conflict as well, with the continuation of Russia and the Ukraine, and then of course the escalation to what we've seen happen in the Middle East. Then on a more investment-focused front, we had the kickoff and the boom of artificial intelligence. That was a big theme. You've seen a lot of companies here in Australia and around the world kind of shoehorn AI into their annual reports and their investor presentations. Just the same as what we saw. I remember when blockchain, for example, was a very large theme a few years ago. You saw dozens and hundreds of companies jam blockchain and blockchain technology into their annual reports. AI, though, I do think is something that is going to be, is stickier, and it is a genuine trend. I personally actually use Google Bard quite a lot, just in my searching of researching things. But I know that's the tip of the iceberg, really, of what AI can achieve. But that was definitely a really strong theme story for 2023. So a lot of pessimism and a lot of negativity and a lot of uncertainty was built into 2023. But it's quite interesting as we sit back and look at the ETFs that make up our portfolios across those main asset classes to see the year that they had. So even though we were sitting back, feeling pretty pessimistic, feeling pretty negative, have a look at the returns that were achieved across the board. And it was a pretty stunning year for these asset classes. So we just have a quick look. I mean, the highest performer, and this is driven off that last theme that we had a look at there, was the Vanguard International Shares ETF that we hold for our international exposure. VGS is made up of about 1,500 companies across the globe. About 60 to 70-ish%, high 60% is in the US. And of course, that is heavily skewed towards those big tech stocks, which certainly got that AI boost. So you can see there over the last 12 months, that did 23%. We then jump back to an unlikely performer. I don't know if we were sitting back this time last year and I was to tell you that the Australian property market and the property REITs did 16% for 12 months, that would be, I'd be met with a lot of skeptical eyebrow raisers. But here we are. It's the second best performing asset class over the last 12 months. Then we've got the ASX 200 with the iShares Core S&P ASX 200 ETF, which did 12%. And then we scale it back there. Bonds had a good bounce back year as well. Wasn't that long ago. We're looking at bonds having their worst, bond ETFs having their worst year since inception in 2022 and 2023. 2022 with the ramp up of interest rates. So that's how, and of course, cash with the interest rates increasing to where they have. People who are now holding term deposits and people who are holding heftier cash balances are finally enjoying some decent returns there on that. But you can see though, over the last 5 years, cash has still been a pretty poor investment. 1.63% over the 5 years. Over the 10-year numbers, just a shade over 2%. I've got a table that shows you how cash has performed as an asset class over a longer period of time coming up, and it still lags behind the likes of equities, property, Australian equity, international equities, and infrastructure as well.
Yep.
So let's just jump forward. If we were to blend these asset classes into portfolios, as we do here at InvestSMART, having a look across the InvestSMART conservative through to our high growth portfolios, you can see, generally speaking, for the last 12 months, a really solid year all round. Now, we don't want to focus on those 1 year numbers. We want to focus on the longer time frame. The since inception numbers this year, come October this year, these portfolios will tick over to their 10-year anniversary. So those since inception numbers for the conservative, balanced growth and high growth are basically just over 9-year figures. So that is certainly what we want investors to focus on. And to get those returns, you need to hold for that time period. So let's jump forward, Tom, and we'll have a look at the major themes that we see unfolding for 2024. I think it's going to be more of the same. So interest rates will certainly still demand the headlines. People will be looking for some relief and some rate cuts. I think if you look at what a lot of the economists are forecasting, those who are forecasting for rate cuts are looking at those for September. Generally speaking, no earlier. We did see inflation numbers come out yesterday that were a lot lower than expected. A few calls there for people to say, hey, does this mean the RBA might start lowering interest rates? Most economists don't think that is the case. They think they will hold, and if there are any cuts, they'll come to the back half of the year. Now, the market is always forward-looking, so the market will move before that does take place. Now, of course, we've got a US election this year as well. It's always entertaining, if nothing else.
It's literally been entertaining this whole 3 years, I guess, coming up to it.
Yeah. But I remember when Trump was elected. I remember all the rhetoric around that in the media. There was a lot of articles, and be prepared for these articles coming up throughout the year. What an election or what a Biden presidency or what a Trump presidency, etc., means for markets. At the end of the day, that actually means pretty little. If you were to, I know Vanguard has a fantastic digital graph that you can use, and you can tick the box to show presidency periods and prime ministerships as well, and how markets have fared through them. And long story short, that news is digested pretty quickly, and it doesn't really have too much of an impact at all, and shouldn't come into a long-term investor's mindset when looking at positioning their portfolio. We still believe, of course, AI will continue to be a major theme. Cost of living pressures will continue throughout the year, and also then the conflicts as well that we're seeing, that they don't look to be coming towards any end. So now, we don't put much stock in forecasting. We don't put much stock in predicting. And when our investment committee meets, they aren't sitting there thinking, which way is the Australian market going to go? They're not trying to second guess that, because all of their decades of experience tells us that we're never going to actually successfully, consistently predict those movements. Instead, what we want to do is hold the market for a long period of time and get those individual asset class returns in a nice blended portfolio.
Yep.
That's what we're trying to do. So hence why I've put a little quote there from an American economist, Noel Burton, saying forecasting the market is like trying to nail jelly to the wall. The experts out there do not try to do it themselves. So instead of predicting, making predictions where these asset classes are going to go and positioning our portfolios like that, what we do is use long-term data to prepare our portfolios and get a broad spectrum of different assets and diversified within those asset classes as well. So we actually get a good range of those outcomes. So if AI, for example, continues to drive US markets, our portfolios have a nice chunk, even from conservative all the way through to high growth. Of course, high growth has got a lot more than conservative does. They have a great chunk of international shares.
Yep.
Okay, so you're going to get that exposure. We have exposure to property. So if the property rally continues, I know there's a lot of talk of people returning to work and businesses getting people back into offices. We are currently in our office right now. And getting the CBDs busier again, that will maybe have a positive flow-on effect to property REITs and whatnot. But if we hold a little bit of that, we'll get that exposure.
Yeah.
Okay.
But we're not going to anticipate it and say, let's put a big chunk deliberately in that, are we?
No, because we could be wrong.
Yeah.
We don't know.
Yeah.
And so we're going to get a bit of that with bonds as well. We've got a little bit of that in all of our portfolios, of course, a bit more in our conservative portfolios than our high growth portfolios.
Yep.
So what we're attempting to do, and what we tell people to do, is to make their portfolio theme proof. So if these themes do continue to play out positively or negatively, you're not overexposed to one or the other. Okay, and so this is a graph, not a graph, it's a table that I got from the Vanguard website. The Vanguard website's got a lot of really good tools to help you develop a long-term investing mindset. I use it quite a lot. You can see here, these are the asset classes going from 2022 to, they haven't got the 2023 year up there just yet, but 2022 back to 2010. You can go back to, I think, 1970, but 2010 was the only one I could fit on the page. And you can see here, so what I was referring to as cash before, we've got a lot of people saying, well, I'm getting X% in my in cash right now. Why would I invest? Well, cash is the grey box. So if you were to have a look, of course, in 2022, cash was the only asset class that had a positive return of 1.3% there. Everything else had a negative return. But if you were to look back at that top line, the top row, all the way back through to 2010, that was the only year that cash was the best performing asset class. Okay, so over the long term, even though, yes, you're getting good rates of return currently on your cash, over the long term, it is still the softest performing asset class. You can see there the average is 2.3%. And that's, I'm looking at that on the bottom left-hand side there. Compared to, say, if you look at the average return of Australian shares over this time period, 7.4% per annum, even Australian bonds, 3.7%, property, 8.4%, international shares, almost 11% there. So for those who are sitting heavy in cash at the moment, yes, cash does play a role, it plays a defensive role in a portfolio. We hold cash in all of our portfolios. But as a long-term investment, especially for people looking to grow their wealth and even preserve their wealth, cash still lags behind every other asset class. So just a word of warning there to those people who say overweight cash. Typically, Tom, when people come to us, we find that they're overweight cash, overweight Australian equities, and underweight pretty much everything else.
Everything else, yeah. I think one of the webinars we did last year, we had a lot of data that we pulled from our own portfolio tracker that our clients like to use to enter all in their data, and it does support that as well.
So let's jump forward, Tom. So basically, instead of looking at predictions, and I apologise, maybe the title of this webinar they've been a bit misleading. We don't want to develop a roadmap just for 2024. 1 year thinking is too short for us. We would like people to sit back and think about their investing in the mindset of their actual investment goal. And so if you've got that mindset of your investment goal in mind, 2024 is just, is just the next hurdle, but you're really investing for, maybe 5, depending on what you're investing for, 5 years out, 10 years out, 20 years out, 30 years out, potentially if you're investing for a child, for example. So instead of sitting here and predicting and trying to guess where markets are going to move, we'd rather focus on understanding our goals, understanding the time frame of those goals, your own risk tolerance, and how you're going to react to markets. Because that's way more important than actually sitting back and trying to predict the next movement. Where's crypto going to go, or where are bond markets, where are property markets going to go?
Yeah, or individual stocks, and trying to predict if that's the next one that's going to quadruple in value, because it's not going to happen in terms of picking it.
So if you sit back, think about your goal, okay, really use this time if you're still off over the holiday period to really nail down what that goal means to you. And then understand the time frame that it's going to take you to reach that goal. Now, on our website, we have our hubs, our goal hubs. So we've got building wealth, saving for retirement, investing for your children, and also, what's the last one? Investing for a property. So they're the hubs that we've got there. Every single one of those has a calculator. Jump on there and play around with the calculator and really lock down the goal that you need. Now, as well, if you when you're on that page, you'll see on the home page, I should say, there's actually an investment quiz that you can start now. This is brand new as of 2 days ago on our website, and that'll walk you through setting up a goal. So we really highly encourage you to do that, because without the why, you then you're kind of a bit all at sea. You're at sea with the different blend of asset classes that you should be investing in. And so, instead of predicting the unknowable, let's focus on what you can control.
I'm just quickly showing you at the top there while you were talking on the InvestSMART page. It's under goals and planning, and there's the different investing goal hubs there.
Yeah, and so if you click that Get Started button there as well, that'll take you through the investment quiz. So what Tom's showing you there now. It's a really cool feature. I highly recommend jumping on and giving that a go. Now, let's. I'm just going to keep on going.
Yeah, go
Tom,
for it. Yep.
just mindful of time. Sure. Great. So the next slide. So when you do have your goal and when you have your time frame, you know what asset. You can then start to look at what asset class blend you should have. And so here I've got a great quote here from someone that we follow the work of. Harry Markowitz won a Nobel Prize in economics for basically developing modern portfolio theory and essentially proving that diversification is the only free lunch when it comes to investing. So he talks about balancing risk and return, and that's what we do here at InvestSMART in our portfolios and what we advocate for people to do with their own investing. Now, one question that often gets asked is, well, if international shares returned the highest over that longest period of time, why don't I just all be invested in that?
Yep.
That's the reason why we don't do that. Even in a high growth portfolio, we don't have 100% international shares. We don't even have 100% international and Australian shares. We have a blend of different asset classes in there. It's because we can't predict when returns are going to happen. That's called sequencing risk. And so that's what blending these portfolios together, blending these asset classes together, I should say, in a portfolio creates a good risk return balance, and which is what Harry Markowitz was saying there. So this is how you plan. So your plan will help determine your risk of your blend of assets. So when you're sitting back thinking about those goals or going through that goal quiz that we've got on the website, what it'll bring you out to is it'll align your goal and your time frame and your risk profile with a blend of assets. So you can see conservative has got a big chunk of fixed interest in cash, and then and a small amount of Australian shares and international shares, and then it dials up from there in the risk profile as your investment time frame goes out. Okay, so we'll quickly jump ahead now. I love this quote from John Bogle. For those of you who don't know, John Bogle is the founder of Vanguard and the inventor of the index fund. Basically, probably the most revolutionary creation in financial markets, the ability to democratize investing and give everyday people exposure to high quality assets at a low cost. So investing is not about beating the market. It's about owning a piece of the market over time. So what we want to focus on now is we're actually going to dive into some investor psychology and some tips and whatnot that you can take away for 2024, of course, and beyond, because 1 year time frame is too short for us. Tom, let's talk about time frame and have a look here.
Yeah, it's very important. Like Mitch has gone through the whole idea of the planning process where we want to get our plan in place, have a goal, understand the time it takes to reach that goal, which is very crucial. And then also talking about tolerance to risk. And this is a great chart because we're focusing on the S&P 500 index, which is arguably one of the most popular, most referred to indices in the world. And this is since 1937. And what it's showing us is the probability of a positive return. So if we start at 1 day, which is obviously very, very short time frame, what it's telling us is if we were to look at all the days presented to us and start picking individual days to look at, there'd be a 53% chance that the day we pick would have been a positive return day. And as you can start to see that the longer we hold the actual, we'll look at the index, the longer we go out. So 1 month, it becomes 63%. And then if you go out to the 1 year mark, it's 77%. And for 10 years, it jumps up to 97%. So one of the biggest things that we find when we talk to new clients, and there's a course that we have on InvestSMART called Bootcamp, InvestSMART Bootcamp. We literally are teaching people the idea that you don't want to be jumping in and out, chopping and changing, not knowing your time frame, because they're literally the recipes to make the cake. It's like leaving out the eggs or the flour, or if you can't drink milk, putting in something else,
So basically as well, this refers back to that John Bogle quote. It's about holding the market, owning a piece of the market over a very long time. And if you're here watching this webinar, there's every chance that you subscribe to the same investment philosophy, or maybe introducing yourself to the investment philosophy that we follow, which is holding ETFs for the long term.
Yep.
And basically this shows that you will, if you basically just hold, and that is your job as a passive investor in an ETF, it's just to hold. Amazing if you can hold and add to it, but just holding over a 1 year time frame, you have a 77% chance of having a positive outcome. Over a 5 year time frame, it jumps up to a 90%.
Yep.
So your job as an investor is just to hold. And this goes back to the themes and everything I was talking about. There is always going to be something to worry about in the market. I've been working in investments for maybe 15 years, maybe more. And I've never not known a time period where there's not been something to worry about.
Yep.
Okay. Be it interest rates. I remember when Greece collapsed, having meetings with an investment committee back then, and all these little things. There'll always be these little things to worry about and be concerned about. But if there's one takeaway for you for preparing yourself for 2024, understand that there will be further concerns about markets and things that will get into your head. But just remember this particular chart.
Yep.
It's just so powerful.
And I think that sort of does feed into the idea that people get caught up with their emotions, they react, they panic. We even find it when we're going through the COVID-19 pandemic. Like, do you remember before that, we had a lot of people who were talking about markets being overpriced. They didn't know what was going to happen. Then we had the drop during COVID. A lot of people were like, the market's crashing. I need to get out of this. Had you stayed though, this is what your chart would have looked like as well. So this is also from the Vanguard website, the actual tool that Mitch was talking about before, when we can actually plot on there the different presidents, even Australian prime ministers, as exciting as that is. And when you do that, you actually don't find that much change to the chart. But what I've got here is 4 standard diversified portfolios. So at the very top, you've got the high growth, then balanced, and then you've got the conservative at the bottom. So, there is a bit of volatility. You can also see that drop, it looks like March 2020, all of them dropping in unison. And that was obviously the COVID-19 pandemic. And that's what would have happened. The volatility is muted in a sense. Basically, the whole idea about having diversified portfolios, and it's a saying that we say all the time, is not having all your eggs in one basket.
Yeah, and throughout this time period, there would have been like 100 reasons for people to worry. I've forgotten most things that have happened between 2014 and now, but I guarantee you there would be dozens and dozens and dozens of reasons for you to worry and panic through that time period.
Absolutely. And you throw in there too the idea that there's been interest rate decreases, interest rate rises, just whole different themes that are coming up.
And currency fluctuations. I know that's a big one right now for people who are wanting to get more international exposure, but that's a concern in their mind. Over the very, very, very long term, we find that you can see it doesn't come into play when with these returns.
And with this chart, it's the exact same chart, and I've just added on the the performance of the US equities, which we can obviously see. If you were to look at this chart and say, "Oh, I wish I had invested solely in that," why don't I put all of it into that? And Mitch has already talked about this. We don't know what's going to happen over the next 10 years for US equities. It could continue its tremendous rise.
Yeah, and you can see the pullbacks are quite a bit more significant as well. So you certainly would need to have a very strong stomach and a very, very long investment time frame.
Absolutely. And that second line that's underneath US equities is the international equities. So that's other markets that obviously aren't the US. But they seem to be there's a high correlation with them as well. But I still put on the high growth, which is a little bit obviously lower, but you could sort of argue that it's still got a lot of exposure to those US equities and also international equities.
You're still capturing that.
Still capturing. And then the one I like the most, the look of it, I should say, is the cash at the very bottom. It's slow and steady. It reflects what Mitch was saying before about 1.9% return on average over the last 10 years each year. So people do sort of get caught up in the idea that right this minute I should have everything in cash because it's going to give me it's stable, a good return. I don't want to risk putting it into equities, for example. It's too much of a risk. Yet about this time, a year and a half ago at least, the interest rates were at all-time lows, and people were talking about how bad cash was and the risk with that. These are the actual asset classes I chose, just with the colors and also the returns. So you can definitely go to the Vanguard site and have a look at their charting feature. It's a fantastic thing. You could spend for hours. But if you look at even Aussie shares, that over the period, which is November 2013 till 2023, it's about 7.3% on average per year each year. And then you've got the sort of standard portfolios on the right-hand side. I'll quickly jump into this one as well, because this is a very interesting chart too, and it plays with the whole idea. And often what we speak to, prospective clients about, or people who are invested, people who aren't invested with us, family and friends, the idea that they try and time the market. So if they are thinking that something's going to happen, they might change their portfolio style, or they might jump out of an asset class. And we saw a lot of people, even since I've worked in investing, where they deliberately tried to anticipate cash giving a better return or a lower return and jumping from one to the other. You're definitely spending more in transaction fees.
Yeah, the biggest takeaway I've had from dealing directly with clients, and it's a lot of people out there who run their own SMSFs a lot. They're very hands-on investors. My biggest takeaway throughout my 15 years doing this role is the worst mistake they can make is actually selling out. So many of them, they'll actually liquidate their portfolio with thinking that something negative is on the horizon, and then what that does is, yes, it might feel good in the short term, but then they have to pick a re-entry point, and that for most is really paralyzing, because say if the market does fall for 5%, their investments fall 10% or something like that post them being out of it. What they then need to do is try and pick a re-entry point, and I can guarantee you when things are down 10% further, they're thinking it's not a great time to invest. And typically what they'll then see is the markets recover. It'll go beyond where they actually pulled out, and now they'll think, oh, geez, the market's too high.
Yeah.
So they have cost themselves transaction costs, tax implications, and then there's opportunity costs because they're sitting on the sidelines, not earning dividends, and watching the market run away from them, causing themselves all sorts of anxiety.
Yeah. It can be
that's
quite difficult.
All from market timing.
And it comes back down to like even the anchoring bias in psychology, where you've got something in mind, so you're always referring back to that. But the thing I like about this is that it shows that, if you were to be someone who doesn't stay invested for the whole period, and this is the S&P 500 again as an example, if you missed the 10 best days from not being invested, you basically lost 45% in the value. And as you can see, if you missed the 20, 30, and so forth. And we'll put these slides up on the website too, because I know that they're not the largest for you there. So essentially, one of the ways that we try and educate people through the bootcamp course, but also just our business in general, is obviously having your investment plan, time frame goal, and your risk tolerance, but almost even acting like a robot. So the idea is that if you remove emotion from your investing and you stick with regular contributions, regardless of what's happening in the market, you get the benefit of dollar cost averaging as well.
Stick to your plan. It all comes back to that investment plan. If you do one thing at the start of 2024 to set yourself up on the right foot, it's to really nut out that investment plan. We've got plenty of materials on our website to assist you with that. If you just stick with that and forget about what the market does, over the long term, you will reap the benefits.
Yeah, and that's even the same, game book that Warren Buffett, plays as well. He doesn't care what's happening in the markets. That's, just wanting good quality businesses. So on that basis, we've covered off those things. Definitely ask questions, but Mitch will run through, what we actually do as well.
Yeah, so basically we have built our entire service off two things: the correcting the flaws in the funds management industry, but also overcoming these hurdles that most people face in their own personal investing. So first and foremost is fees. We cap our management fees at $550 per annum. So no one in our InvestSMART diversified portfolios will pay any more in a management fee than $550 per annum. Compare that to a 1% management fee or a 0.5% management fee. It's basically, it ends up with more money in your account, earning dividends and earning capital returns. Okay, it's that simple. If you can control, it's just like savings. If you can control your expenses, you're already well ahead of the curve. The second thing is we use passive investment vehicles. So we use ETFs and passive index tracking ETFs to get those returns for our clients. And so why we use those is because we can easily get a spread of different asset classes, and we can get great diversification within asset classes. So we're not left exposed to one set of companies or one sector, etc. So that's and then so we diversify, low cost, and then we have automated settings in your account for you, so you can set up your investment plan and stick to it. So you don't even have to think about it. That could be for someone growing their wealth, or for someone in retirement, say living off their portfolio. We've got a setting called, which is really popular, called an income sweep. So basically, every single month we see whatever income's been paid out to your portfolio. We wrap that up for you. We transfer it out to a bank account of your choice. And we also have regular withdrawal plans for people who are in retirement as well. And so they could have, say, a set $1,000 a month coming out of their account. They could also have that in conjunction with the income sweep. Because the ETFs that we use pay quarterly distributions, the income sweeps can be quite lumpy, of course, around those quarters, and the months that don't fall on those quarters can be quite lean. So people do use that regular withdrawal feature. So we have built this service that's low cost, passive, secure. It's held on your own, on a HIN in your name or your super fund's name. InvestSMART's not the legal owner. Our clients are the legal owners.
Yep.
So it's absolutely as secure as you can get, holding an investment yourself directly, say through a broker like ComSec or NabTrade. So let's just wrap up here, Tom, with our top tips for 2024. Now, there's a really good article. If you look on our insight section, there's a whole stack of tips from our investment experts. You look for Paul Clitheroe with the Santa Claus hat on. That article will take you into Paul's tips, Effie Zarhos's tips, Alan Kohler's tips, and a couple of us who talk with our clients every single day, their main investment tips for 2024. Ours are very, very broad. So for me, it's avoiding reacting to news. The news is not there to help you. It's not there to help you become a better investor. There's so many ways people make money from the market, like other people, other than actually investing. They make it from clicks. They make it from you trading. They make it all sorts of things. So if you do not react to the news, you're going to be well ahead of the curve when it comes to investing. In fact, if you program yourself to not worry about headlines like billions wiped off markets today, which always gets trotted out, if you actually think about inverting that, and when you hear billions wiped off markets today as an investment opportunity, I know we don't advocate market timing, but if you think about it that way, and which I know I do, that's taken a long time though, by the way, to get to that point, because you have to. It's a big psychological factor.
Absolutely.
You're going to really benefit from that. Now, the other one, do not interrupt your compounding unnecessarily. This is the really, really big thing that I was talking about with people that I've experienced have really negative investment experiences. They have a short-term pullback in the value of their portfolio, and they extrapolate that into the future, and they liquidate an investment. When we know, if we go back to John Bogle's advice there, it's about holding the market for a long period of time and reaping the benefit of compounding. Stick to your plan. As I said, we've now got that quiz on the website, so go to investsmart.com.au and you'll be able to take our investment quiz there. Highly recommend going through that as we walk you through an investment plan step by step within about 3 minutes. It's really useful. Finally, keep learning and keep it simple. I know Paul Clitheroe's main wealth tip for everyone is to keep it simple, and it's about spending less than you earn, reducing your expenses where you can, and just investing incrementally over time. It's really, really straightforward.
You can book a call with the team as well. On the website, there's questions and answers, and that actually brings us to the question and answer part. And we've got some great questions here as well. So definitely put your questions through. I'll present them on the screen like I have here for Richard's. Richard saying, I get that your fees are capped, which is good. Presumably there are fees charged by the ETF providers. And yes, there is. You'll pay those ETF fees whether we manage it for you or whether you decide to do it yourself. What we'll do, and I'll quickly actually show just on the website, if you go to the page investsmart.com.au and go up to invest, you can click on it from there actually, and it will show you the portfolios that we've been talking about, the diversified ones. Let's pick.
Let's jump into growth.
Let's try growth. It's right in the middle there. So we scroll down and we actually can see the performance. If we go down to key facts, go to asset allocations and holdings, and you can see on the left are all those asset allocations we were talking about. On the right-hand side, though, you can actually see we're very transparent about this. These are the ETFs that we'll purchase on your behalf to get you exposure into, say, like a growth portfolios. You can Google each one of these on the internet.
I think if you go back to details, there's even the fees section, there should be indirect costs.
Indirect costs.
So what Richard's referring to here is a thing called ICR, which is an indirect cost ratio. And basically, yeah, as Tom mentioned, if you were to invest through us, or if you were to jump on your ComSec account or a NAB trade account and buy a Vanguard ETF or an iShares ETF, you would be paying that underlying ETF expense that comes out of your return, out of your dividend. And they're really low. We choose really low cost ETF providers to build our portfolios with. But then people say, well, if I'm paying for the ETF, what am I paying InvestSMART for? Essentially, you're paying us to select these ETFs. There's about 300 ETFs on the Australian market. We're handpicking these, we're monitoring, and we're rebalancing over time for you. And essentially, people going out there, we have the ETFs here. You can see them, and you can go out there and buy them yourselves. But we get wholesale brokerage rates as well. So what we find is most people can't actually do it cheaper than what we charge them. And so for the fact that we're being able to select the ETFs, monitor the ETFs, rebalance your portfolio over time, reinvest your dividends, or pay you that income stream if you wish, for the low cost and the peace of mind that comes with, and the fact that people can go off and live their life and not manage their own portfolio. It's a small price to pay.
Yeah, I think the biggest thing to take away from that too is the rebalancing part, because if you're telling us, InvestSMART, we want a growth portfolio, we want that kind of risk profile, do it. Our job is to make sure that we stick to that. So say, for example, if you're looking at this one here, the growth and Australian equities, we're holding about 28.25% of the entire portfolio in Aussie equities. If Aussie equities was to take off, I guess it comes back down to that psychology part too. If you're your own investor, you're sitting there going, gee, what do I do? It's taken off. It's now, 35% of my portfolio. Should I cut it? Should I? And that it leads back into another question that we had, which was excellent. The segue here is going well. What would cause you to sell something? And it's, I guess, a two-part question, isn't it?
Because it's about rebalancing.
Rebalancing, but there's also the investment committee that meets every quarter at the same time.
Yeah, so our investment committee, as I mentioned, there's about 300 odd ETFs on the market. I know the likes of Vanguard and iShares, for example, recently went through a period where they reduced the fees in their ETFs as well. So there's all sorts of things happening in that market, and when we meet as an investment committee every single quarter, we're sitting there and reflecting on the ETFs that we hold, reflecting on new ones that have come onto the market, and reflecting on any changes that have happened within them. And so if there is a cheaper, viable alternative to the asset class that we want, then we may switch that out. Now that does happen pretty rarely, because we only invest in the lowest cost asset ETF providers. So it is rare. But another time, Bob, to your question, what would cause you to sell something, is rebalancing a portfolio to stick with someone's investment plan. So if you're taking an income from your portfolio, we will maintain the balance. So we'll trim the holdings for you, in keeping the balance of the portfolio to free up that cash to provide you for your income. So that's when you'd sell. And I think you might be also referring to what I was saying it's your job's just to hold. We do not preempt. We do not try and time market events. So we hold. We know the best thing. All of our experience tells us to do is if there is a correction, it's to hold through that period. Every single one in history has shown us that just holding through it and not trying to jump out and jump back in at an opportune time is the best course of action.
Yeah, I was going to quickly say as well, like the if I go up the top to invest and say who we are, we've got some pretty good names on our board, like Paul Clitheroe, Effie, Alan Kohler.
They're all part of our investment committee. So they are the ones that are sitting there making sure that our portfolios are sticking to the mandates that we say we're going to do.
But if you were to ask them, what ETF should I invest in because it's going to do this amount per next year, they would say, not sure, long-term time frame, stay in the market. It brings us to another question as well that Karen's asking here, saying that we mentioned Buffett. Want to offer a Buffett-style management service where fees are only charged if a benchmark is beaten. And
I don't know. Buffett, of course, runs Berkshire Hathaway. I don't think there's any performance fees or anything like that associated with it, to my knowledge.
The only thing I can think of, though, is obviously Warren Buffett follows the value investing principle, and it's obviously a bit of a plug here for the other part of our business, Intelligent Investor.
Intelligent Investor. One thing as well, Karan, though, looking at the InvestSMART approach is not to beat a benchmark. It's not to beat the ASX 200 or to beat. It's to get that asset class return, to get a passive index return. And if you're an index investor, you're not going to beat the index. So our fees are designed to be as low as possible. Even if we, had I don't think there is a fund manager out there in Australia that caps their fees and has a lower fee than us.
Yep.
So if you find one, we definitely love to see it. But essentially, we are not trying to be clever and beat benchmarks. We're trying to get the index return in a blend of multiple indices into the one portfolios. That's what we're trying to do in these portfolios. Now, Tom was referring to our sister company, the Intelligent Investor. The Intelligent Investor does follow a value investing approach where the team are actively picking Australian and international companies trying to beat a benchmark. So if you jump over to that page, you'll see that they also offer managed funds, and the guys have been quite successful over a 20-year period of handpicking individual companies. There's another interesting question
from Andrew.
Let's go to Andrew. African Argo. Do the portfolios include low-cost LICs? So when we're putting together our ETF portfolios, one big thing that we're looking for here, Andrew, is liquidity. And so so we will favour, if, say, for example, there is two Australian equity ETFs that both invest in the ASX 200, and they have a management fee of 0.1%. But one's been operating for 20 years and has millions traded every single day in it, and the other one has been operating for 2 years and has a few $100,000 traded every single day in it. We will favour the ETF that has the longer track record and has the deeper liquidity pool. So the reason why I mention that is African Argo, they are listed investment companies, meaning you are actually buying and selling shares from other investors. And so the liquidity pools aren't there that we require, but also they are not 100% passive, even though African Argo, over the long term, their returns do tend to revert to the index returns, even though I think they have just slightly beaten them. But they are active managers underlying, so that's a reason why. I can't remember what their fees are, but I'd say they're really probably very comparable to the ETF, the Australian equity ETF that we use, which is IOZ, the iShares ETF. I'd have to look that up, but that's essentially why liquidity levels, and they are, even though a lot of people view them as a substitute for an index fund, there is a level of active management going on inside them there. So we want pure passive exposure to the ASX 200.
Excellent. Yep, and that's nice. Thank you so much for all the nice comments as well. We truly appreciate it. We always try to make these as interactive as possible and literally get the information that we think that you might like. So if you've ever got feedback, let us know. We'd love to be able to give you as much information. Let's have a look at the growth fund chart. That's a great question, David.
Yeah, absolutely. So they have recovered from where they were. Let's have a look at. So this is only up to November. So we have the website. I was a bit ahead in my numbers that I put up earlier in our presentation. Keep an eye out on the website, and those numbers will be updated. But
so it looks like
no, so that's the peers. But if you go to the
so December looks like
So 2022 was a pretty rough year. If we Tom, if you go back to the presentation.
Sure. Yep.
And sorry, this is if you jump up a few slides, quite a few slides. So there's that one.
This one with your little squares.
Excellent. Yep. So if you see 2022 was a pretty rough year for most asset classes except for cash. And so if we see, what Australian shares did in what colours? Australian shares, sorry, this is a really difficult one to read. It's the light blue, so -3%. International shares did -12.5% in 2022. Bonds got absolutely hammered. So that's the reason why. So we've ridden that wave, and then we're coming out the other side there, David. So 2022 was a pretty rough year for all asset classes. But as I said, we stay invested and we recover from that. We go on to hit new highs. As when you do jump onto the website in the next few days, those end of year numbers will be up, and you'll see that'll be up even further from there.
And the thing to remember too is when you're holding on to those investments, you're still receiving
income, absolutely.
You're not missing out on the slide I showed before, like if you miss the 10 best days, the 20 best days, etc. You're staying in the game. You're not liquidating. You're not, having capital gains, consequences, etc.
So you want to go back to the previous slide there, Tom? There's our contact details on this slide, and for those people who have come along, actually not there. For those people who have come along, though, please feel free to reach out to myself or Tom. My email address is m.sneddon, that's SNEDDON, at investsmart.com.au. For people, anyone who's interested in doing boot camp, Tom here actually operates boot camp. He does live webinars every single week for it. It's really low cost. It's a great way to get your friends and family investing if they keep asking you investment questions. And he also offers a boot camp for business. So for people out there who are operating businesses themselves and think that, hey, I'd like to offer a nice little incentive for my staff or get my, improve financial literacy for my staff. It has a lot of flow on positive effects. Tom runs a business. There's a business for boot camp for business subscription that you can get to where you can get multiple logins to that. So t.wilson at investsmart.com.au is his email address. Please reach out. But everyone, thank you very much for joining us. Thanks for all the questions. If anything does pop up and you want to chat to us, there's a chat function on the website that you can use in the bottom right-hand corner. Please, that we do man that, so it's manned Monday to Friday, 9 to 5. But also reach out to us, send us an email. Happy to talk with all of you.
Excellent. So thanks so much, and we'll see you for the next webinar. And reach out and let us know what you want us to cover as well. Thank you.